The impact of banking regulation on the emergence of crises in emerging countries. This article is written by Remecki. Contribution and originality of the study is that this study contributes to the existing literature by considering that the vulnerability of banks in emerging countries reflects a fragile and inefficient banking system. Thus, a strong restriction of certain banking activities accompanied by a deterioration of the macroeconomic factors and a weakness of some institutional factors can lead to banking crises. In this study, we analyze the regulatory, macroeconomic and institutional environmental effects on the probability of the emergence of banking crises in 78 emerging countries that had a fragile banking system in 1997 in a cross-sectional study using a logic model. The empirical examination validates a link between the weakness of certain regulatory and macroeconomic factors and of newly liberalized emerging market banking crises. This study wants to examine weakness of regulatory and macroeconomic factors of newly liberalized, etc. banking concentration, restrictions on insurance, the financial market and the real estate sector were not related to the outbreak of banking crises in our estimates. On the basis of results, this study concludes that good regulation leads to bank stability. However, certain restrictions on inappropriate banking activity were the causes of the emergence of banking crises. As a result, the fragility of macroeconomic and institutional factors and the lack of diversification has clearly led to bank fragility and consequently to banking crises. Thanks for watching this video of Asian Economic and Financial Review Volume 9 Issue Number 8.